$725 billion. That is the AI infrastructure plan for this year alone, across just 4 companies. More than the entire GDP of Belgium. And the yearly step keeps growing. 184 billion more in 2025, then 315 more in 2026. The last time investors were this excited about a build-out, the Nasdaq ended 78% down. Bubble or build-out of the century? Do not guess. Run the audit. The number. The trajectory, roughly 128 billion in 2021, near 150 for 2 years, then the turn. 226, 410, and roughly 725 guided for 2026, a 77% step in 1 year. Who spends it? Amazon guides around 200 billion. Microsoft around 190 on a calendar year basis. Alphabet 185. Meta up to 145. Together, tech Capex is now over a third of all S&P 500 Capex. But guidance is not a check that cleared. The first quarter prints. Amazon 44.2 billion. Alphabet 35.7. Microsoft 30.9. The market grades this in real time. Meta dropped about 6% after raising its Capex range. Alphabet rose on cloud strength. Same spend, opposite verdicts. Morgan Stanley sizes the full 2025 to 2028 build-out at $2.9 trillion. Zoom out. Telecoms.com build-out peaked near 1% of US GDP. AI Capex is already past 1.2. The railway mania of the 1880s hit 6. What 1999 actually looked like. The baseline. The Nasdaq rose about 600% into March 2000, peaked at 5,048, then fell 78% by October 2002. The IPO window told the story first. First day pops averaged 65% in 1999 and 2000. The 80s averaged 7. Then the window slammed. 311 IPOs a year on average before the bust. 102 after. Down 2/3, and it stayed there. Under the market sat the telecom build-out. Vendors like Lucent and Nortel lent customers the money to buy the gear. Traffic doubled once a year, not every 100 days as claimed. 23 telecoms went bankrupt. 500,000 jobs went with them. By November 2000, most internet stocks were down about 75%, and $1.755 trillion of value was gone. Concentration is heavier now than 2000. The top 10 are 43% of the index, versus roughly 27 at the dot-com peak. But the leaders are different animals. Today's giants print net margins above 25%, versus 13 for the average company. How it is financed. Here is the rhyme. The build-out ran on cash flow. The BIS says it is shifting to debt through channels too opaque to measure. October 2025 set the template. Meta and Blue Owl closed $27 billion in A+ rated debt, plus $2.5 billion of equity, for one Louisiana data center. The largest private credit deal ever done. PIMCO alone took $18 billion. Meta keeps just 20%. AI borrowers took over $200 billion from debt markets in 2025. JP Morgan expects $30 to $40 billion a year of securitization on top. Then there is the money loop. NVIDIA invests in OpenAI. OpenAI commits hundreds of billions to Oracle, Broadcom, and Microsoft, and they buy NVIDIA silicon to serve it. Round it goes. And not just OpenAI. Google puts up to $40 billion into Anthropic, which commits $200 billion back to Google Cloud. Circular arrangements tally north of $800 billion. OpenAI's own forward commitments run about $1.15 trillion through 2035. Two different metrics, both real. And the hub of that loop reportedly loses about $14 billion this year, while projecting $100 billion of revenue by 2029. One more crack, the machines. Operators book GPUs over 6 years. Engineers estimate 2 to 4 on a chip cycle now annual. Even the giants split. Meta just lengthened server life. Amazon shortened it. The Steelman, because there is one. If end demand is real, vendor financing is just vertical integration with extra steps, which makes the next chapter the whole ballgame. The demand ledger. Inference, actually serving users, is now 2/3 of all AI compute. In 2023, it was 1/3. And agentic workloads compounded. consuming 100 to 1,000 times the tokens of a chatbot request. The physical economy agrees. Micron's high-bandwidth memory is sold out through 2026. Server memory prices are surging. Apollo calls it a growing compute shortage. Scarcity, not glut. Revenue is following. Anthropic reports a $47 billion annualized run rate, up from 30 in April. OpenAI confirms about 24. Both figures are company reported. One caveat stays on screen. OpenAI disputes roughly $8 billion of Anthropic's number, an argument about gross versus net cloud revenue. Now the honest bear case. MIT found 95% of enterprise AI pilots showed no measurable profit impact yet. Read the fine print though. The study measured rapid payoff, and it blames integration gaps, not the models. Widely miscited, still the strongest exhibit against. On corporate cards, Anthropic just passed OpenAI for the first time. 34.4% of enterprise AI spend to 32.3%. More than 1,000 companies now spend over $1 million a year on Claude. 8 of the Fortune 10 are customers. And Google Cloud's contracted backlog passed $460 billion. That is signed future demand, not sentiment. The liquidity stress test. First, a category note. SpaceX is not an AI company. Its IPO tells us nothing about AI fundamentals and everything about what public markets will absorb right now. On June 11th, SpaceX priced at $135 a share and raised $75 billion, the largest IPO in history. With the green shoe, $85.7 billion. Day one, it closed up 19.2%, around a $2.1 trillion company, sixth most valuable on U.S. markets. It has since traded past 2.6. The whole capital calendar on one line. Meta, $30 billion in bonds in October. Alphabet, $25 in November, $30 more in February. SpaceX lists in June. Amazon, $25 billion this month. Anthropic targets October. OpenAI is weighing 2027. Both dates are reported, not confirmed. And an OpenAI slip to 2027 is already in play. The price is discussed. Anthropic's last private round closed at $965 billion. Secondaries imply more. OpenAI reporting points at $852 billion to $1 trillion. Illustrative math, and only that. At conventional multiples, the three need roughly $150 billion of combined earnings. Today, they lose about 20. And that aggregate hides real divergence. Anthropic reportedly tracks toward operating profit this year. OpenAI carries about $14 billion of the losses. Against Ritter's baseline, 1999 meant 65% average pops before the slam. SpaceX popped 19. The window is open and warm, not yet 1999 hot. That reads appetite, not where anything should trade. So bubble or build out. Both stories hold real pieces. Capex is real and still accelerating. 226 to 410 to 725 billion. Financing is drifting from cash to debt and loops, the sharpest 1999 rhyme. Demand still outruns supply everywhere we can measure it. And the window just absorbed $75 billion, with 2 mega listings still queued. Do not call the top. Watch the funding mix, the loops, and the IPO window every quarter. Every number in this video is sourced in the description with dates. Follow InferenceWire for what the AI headlines actually mean. See you at the next print.